Welcome back everybody to another week of learning. This week we're going to be covering time value of options. It's kind of a continuation on our options series where we discuss different Greek letters, different aspects of options and how to use them in your trading and investing. So this week we're going to be looking at time value, and it's also known as theta in the option world. So I hope you guys can learn something new and apply it to your trading, and I'll see you all next week. Hello ladies and germs, and welcome back to the channel. Today we're taking a look at an option's time value, and this is also known as theta, which we'll cover in a minute. So an option's value is made up of two important components. So it's extrinsic value and intrinsic value. So the intrinsic value of an option is essentially the moneyness of the option contract, and it makes up the largest part of the overall value of the option. So for example, a deep in the money option has a lot of intrinsic, or also known as real value. A deep out of the money option has almost no intrinsic value because it has no value in the market. This in itself makes it so that out of the money options are much cheaper than in the money options, strictly because of this intrinsic value difference. Now, extrinsic value, on the other hand, captures all other factors that affect the option's contract value, not based on intrinsic value. They move to keep the markets efficient, and so there's no opportunity for arbitrage in a perfect world. So the biggest factors that include the Greeks, and most notably are these ones. It includes volatility, interest rates, dividends, and time value, which we're going to be talking about today. Both intrinsic and extrinsic value are pertinent for pricing options, and they're very important, both of them, to consider. Today's focus is on a component of intrinsic value called an option's time value. Now, the Greek associated with time value and time decay, as it's commonly referred to, is theta. So the idea is that the length of time to expiration has value, and this actually decays as expiration becomes closer. This time has value to an option holder. And because of this property, theta of a long option contract is negative. Essentially what this means is that the value of the option is falling by theta each single day until expiration, so it's a daily value. And as expiration approaches, theta becomes larger, so this means that time decay is actually speeding up. And this happens because there's less time for the option to become profitable or in the money. And now we can take a look at a chart here that kind of depicts how exactly that would happen. Here on the y-axis we've got the theta level and expiration on the x-axis, and we can see as expiration approaches, theta becomes increasingly large and accelerates time decay. Theta is largest for options that are currently at the money. And this is really important, as an option transfers from in the money to out of the money, therefore going through the at the money point. Most of the time value is lost. Most of the time value is lost, sorry. In other words, this means that theta quickly decays when this occurs. It's also very important for traders, this concept, especially since it can be used as an income strategy for individuals that write option contracts or sell them. So theta in this case will be positive, or a credit to those parties who do this. So as an options trader, if you trade longer term options between 6 to 18 months or longer, you actually might want to consider rolling your position, and I'll get into this in a moment, when it is approximately 30 days to expiration. So at this point, theta decay really speeds up, and it's at its quickest decay. You can either roll your position to a new contract with a further out expiration of the same option, which is where we sell or buy a contract in one transaction. That's essentially a rollover. Or otherwise, you can simply sell to close the contract, which is another option you have, and you can do this 30 days out. But as an option writer, it may be in your favor to sell a call or put within the 30 days between expiration. to capitalize on that time decay. But other Greeks also play a role, so you need to be very aware of this. So the pros and cons that exist in doing so from doing this income strategy. An important dynamic that also exists is between delta and theta. And if you need a background on delta and gamma, I suggest you watch last week's video, it's a good one. Essentially, the relationship stems from the fact that theta is affected by the moneyness of the option, as we've talked about, which is precisely what delta seeks to measure. And if you remember, it's the percentage of profitability of delta, which it represents. So specifically, when delta falls as an option moves from out of the money to in the money, theta also experiences significant decay. This means that they have a positive relationship between them. As we've discussed, delta measures the probability of profitability of an option. So as delta does fall, there's a smaller chance of it being in the money or profitable. So there is less time value. So in conclusion then, theta can be a valuable tool as an income strategy when you write options or sell them. But when you're purchasing an option contract, it's important to be wary of the 30-day to expiration threshold that's historically known for an option to lose its time value very rapidly. Of course, all this is discussed in a vacuum. The other Greeks will interplay with theta, making matters more tricky to decipher and makes your decision a little bit trickier. The extrinsic value is determined by all Greeks collectively, so it's important to keep this in mind again. Therefore, proper analysis and weighing your options, no pun intended, is your best bet to succeed. And I'll see you guys next week.